what these housing numbers mean for the economy, let's bring in Meyer, senior U.S. economist at Merrill Lynch. She joins us now from her office here in New York. Michelle, thanks so much for joining us on Bottom Line. Appreciate it.
Nice to be here. Thank you, Mark.
Michelle, fewer first-time home buyers are entering the housing market, and these are the buyers that usually stay in a community and raise a family. What does this mean for the overall housing market and for communities that are still reeling from the recession?
I think it means that there's still going to be a long path and a painful one before the housing market looks normal. The typical buyer is not really participating. As Michael said before, first-time buyers only a third of sales. Investors are a larger share of sales. Distressed sales are moving a lot faster. So the first-time home buyer, the move-up buyer, they're not really participating right now. And I think that means that housing is still out of whack. We're not in an equilibrium yet, and we probably won't be for a while.
And as Michael correctly pointed out, he mentioned that real estate lending down for 2 years, at least down for Wells Fargo today, basically dead at the moment. When does that start to turn around?
That's a gradual process. We're already starting to see some evidence that things are moving a little bit better. Demand for mortgage credit is starting to pick up. That's a good sign, but it's still very feeble. All cash sales were 35% of sales, which means that a lot of the activity that's happening now are people who are buying without financing.
Right.
And this is happening in an environment where mortgage payments as a share of disposable income are close to record lows.
Well, as you mentioned, foreclosure is still dragging down prices. Well, how much further do housing prices have to fall?
I think we still have some decline left ahead of us for national home prices. Our view, we'll see a 5% drop in national home prices this year. It could be larger. What dictates that forecast is the share of distressed properties. So the increasing share of distressed sales will continue to exert downward pressure on home prices because they sell at a discount.
Michelle, how long is it going to take to clear the supply of homes for sale?
It's going to take many years. If you think about what's in the current pipeline, it's very large in terms of distressed properties. The current inventory, it takes 8.4 months to clear what's on the market for sale. Then take into account what's in the shadows, and that number gets a lot larger. So I think it's certainly going to take until 2013 to work through a lot of the foreclosures, and probably a bit after that before you can have housing demand equal housing supply.
What risk does the potential for higher rates following the end of the second round of quantitative easing have on an even fragile recovery?
In our view, we don't think we'll see very much of an increase in interest rates after QE2. But that said, if we do see a spike, and it's an exogenous spike, so it's happening without the recovery picking up speed in the economy, then clearly it would be negative for housing.
Michelle, in our last 30 seconds, have you factored any of these effects into your current forecast, or is this something right now you would still just consider a downside risk to what might be your baseline?
Well, we're more bearish on the economy than I think most people are. We're looking for 1.5% real GDP growth in the first quarter and only 2.5% for the year. So we've taken into account the continued drag from housing. I would say the downside risk comes from other factors like a bigger increase in oil prices or further constraint in credit.
All right, Michelle Meyer, senior U.S. economist at Merrill Lynch, joining us. Michelle, it's always a pleasure. Thanks so much.
Great to be here. Thank you, Mark.